In the break-even analysis, the x-axis shows the output or the number of units produced. The y-axis shows the cost and revenues that the business makes by producing a particular product. The fixed cost line is in green. It is always horizontal because this cost does not change even if the output has increased. The average variable cost line is in red. This cost increases proportionally to the output. The total cost line is in purple. We can observe that this is parallel with the average variable cost line. This happens because the total cost equals to the fixed cost plus average variable cost. The total revenue line is in blue. It shows the total amount of money received at a certain level of output. The break-even point is where total revenue equals to the total cost. The point where the blue line intersects the purple line. At this level of output, the business has just made enough money to cover all costs. Break-even revenue is the amount of cost and revenue where total cost equals to the total revenue. Break-even quantity refers to the level of output to reach the break-even point. The margin of safety is the horizontal length between the level of demand and the break-even quantity of the product. A positive margin of safety means the business makes a profit. A negative margin of safety means the business makes a loss. There is profit where total revenue is greater than the total cost. The area between these two lines on the right-hand side of break-even point is the profit. On the other hand, the left-hand side of the break-even point, where total revenue is lower than total cost, is the loss. When price decreases, the cost is not affected. However, the total revenue will decrease, which lowers the profit or increases the loss. When the price increases, the cost is also not affected. The total revenue will increase, which increases the profit or lowers the loss. When fixed cost decreases, the total cost decreases as well. The break-even point can be reached at a lower level of output. When fixed cost increases, the total cost increases as well. A higher level of output is required in order to reach the break-even point. Changes of average variable cost is similar as the total cost. When the average variable cost decreases, the total cost decreases as well. The break-even point can be reached at a lower level of output. When average variable cost increases, the total cost increases too. A higher level of output is required in order to reach the break-even point. Target profit is a method which a business sets an amount of profit that it expects to reach. Using this formula, the business can calculate the level of output needed to make a certain amount of profit. For example, Company X wants to earn $3,000 of profit. The fixed cost is $4,500. The variable cost is $8 per unit. And the total revenue is $20 per unit. Then we substitute the numbers into the formula to find the level of output.